On October 29, 1929, 16 million shares changed hands in a single day.
By the time the closing bell rang, $14 billion had vanished.
Men who woke up millionaires went to bed broke. And the worst part?
Almost nobody saw it coming. The signs were everywhere.
Welcome to Daily Investor.
Today we are going back nearly 100 years to study the most devastating stock market crash in American history.
Not just because it is a fascinating story, though it is,
but because the exact same mistakes investors made in 1929 are being repeated right now, in 2026.
The technology is different.
The ticker symbols have changed.
But human psychology? That has not moved an inch.
By the end of this video, you will understand exactly what caused the crash, how it destroyed an entire generation of wealth, and the 3 warning signs you can watch for today.
This is not financial advice, it is a history lesson.
And history, as they say, does not repeat, but it absolutely rhymes. To understand the crash, you first have to understand the party that preceded it.
The 1920s were electric. The economy was booming.
New technologies like radio, automobiles, and commercial aviation were reshaping daily life. Between 1921 and 1929, the Dow Jones Industrial Average rose from about 63 to a peak of 381.17 on September 3, 1929. That is a gain of over 500% in just 8 years. And it was not just Wall Street professionals getting rich.
For the first time in American history, ordinary people were pouring into the stock market. Shoe shine boys, taxi drivers, housewives.
An estimated 1.5 million Americans owned stocks by 1929, up from just a few 100,000 at the start of the decade. The vehicle that made all of this possible was margin buying.
Investors could purchase stocks by putting down as little as 10% of the price and borrowing the rest from their broker.
So if you had $1,000, you could control $10,000 worth of stock.
When prices went up, your gains were magnified tenfold. It felt like free money.
By 1929, broker loans for margin purchases had reached $8.5 billion, more than the entire amount of currency circulating in the United States at the time.
Let that sink in.
Americans had borrowed more to buy stocks than all the cash in the country. Companies like Radio Corporation of America, known as RCA, became the darling of speculators. RCA never paid a dividend, but its stock soared from about $12 a share in early 1925 to a peak of $114 by September 1929. People were not buying stocks based on earnings or book value. They were buying because prices were going up, and they assumed prices would keep going up.
Benjamin Graham later called this the greatest speculative orgy in history. The first cracks appeared weeks before the crash. On September 3, 1929, the Dow hit its all-time high of 381.17. Then it began to drift downward. Slowly at first. By mid-October, the index had slipped to around 325. Investors were nervous, but most believed it was a normal correction. Then came Thursday, October 24, 1929. Black Thursday. In the first hour of trading, panic selling erupted. Nearly 13 million shares traded hands, an unprecedented volume. The ticker tape, which printed stock prices, fell nearly 2 hours behind the actual market. Investors across the country had no idea what their stocks were actually worth. They just knew everyone was selling. At noon, a group of the most powerful bankers in America gathered at the offices of J.P. Morgan & Company at 23 Wall Street. Thomas Lamont of Morgan, Charles Mitchell of National City Bank, Albert Wiggin of Chase National Bank, and others pulled together an estimated $240 million to buy stocks and stabilize the market. Richard Whitney, the vice president of the New York Stock Exchange, walked onto the trading floor and placed a dramatic bid for 10,000 shares of U.S. Steel at $205 a share, well above the current price. The market rallied. Newspapers declared the crisis over. They were wrong. The following Monday, October 28, the Dow fell 38.33 points, a drop of nearly 13% in a single day. There was no banker rescue this time. And then came Black Tuesday, October 29, 1929. The day the Roaring Twenties died. 16 million shares traded. The ticker fell 2.5 hours behind. The Dow plunged another 30.57 points, dropping roughly 12%. In those 2 days alone, the market lost about 25% of its value. But here is what most people do not realize. The crash did not end on Black Tuesday. It kept going. By November 13, 1929, the Dow had fallen to 198.69, nearly half its September peak. And it still was not over. The market continued to slide for nearly 3 more years. By July 8, 1932, the Dow Jones Industrial Average bottomed at 41.22. From the peak of 381 to the bottom of 41. That is a decline of 89%. If you had invested $10,000 at the market's peak on September 3, 1929, your portfolio would have been worth just $1,100 3 years later. And if you had bought on margin with 10-to-1 leverage, you did not just lose your money. You owed money. The leverage that multiplied gains on the way up destroyed people on the way down. Behind the numbers were real people. Thousands of families lost their entire life savings. Banks that had speculated with depositor money began to fail. Between 1930 and 1933, roughly 9,000 banks collapsed across the United States. Depositors who never owned a single share of stock lost everything because their bank had gambled with their money. Unemployment soared from about 3% in 1929 to 25% by 1933. Breadlines stretched for blocks. The Great Depression had begun, and it would not truly end until World War II. And here is the detail that should keep every investor up at night. The Dow Jones Industrial Average did not return to its September 1929 peak of 381 until November 23, 1954. 25 years. If you bought at the top in 1929 and simply held on, you waited a quarter of a century just to break even. That does not include inflation. Adjusted for inflation, the recovery took even longer. Benjamin Graham, the father of value investing, lost heavily in the crash himself. He went into 1929 with a leveraged portfolio and saw it devastated. But rather than walk away from markets, he spent the next few years studying what went wrong. In 1934, he published Security Analysis with David Dodd, laying out the intellectual framework for analyzing stocks based on their fundamental value rather than their market price. The crash did not end Graham. It created him. So what can we actually learn from 1929? 3 things. First, leverage kills. When times are good, borrowing to invest feels like genius. But leverage is a double-edged sword that cuts deepest on the way down. In 1929, 10-to-1 margin turned a correction into financial annihilation. Warren Buffett has said repeatedly, and I quote, "If you are smart, you do not need leverage. If you are not smart, it has no business being used." When you see people borrowing to buy assets at record prices, that is a warning sign. Second, when everyone is speculating, nobody is investing. By 1929, people were not buying stocks because the businesses were profitable and fairly valued. They were buying because prices were rising. That is speculation, not investing. When your taxi driver is giving you stock tips, as the famous story goes about Joe Kennedy before the crash, the market has become disconnected from reality. Price is what you pay. Value is what you get. When people forget that distinction, a reckoning always follows. Third, markets always recover, but your timeline matters. Yes, the Dow eventually reclaimed 381. But 25 years is a long time. If you were 60 years old in 1929, you did not live to see the recovery. The lesson is not to avoid the market. It is to never put yourself in a position where you are forced to sell at the bottom. That means no leverage, an emergency fund, and a time horizon measured in decades, not months. Here is the one thing I want you to take away from this story. The 1929 crash was not caused by some external catastrophe. There was no war. No pandemic. No natural disaster. It was caused by ordinary people making the same mistake that investors make in every generation. They confused a rising price with a good investment. They used borrowed money to bet on the crowd being right. And when the crowd turned, there was no one left to buy. As Benjamin Graham wrote, the investor's chief problem, and even his worst enemy, is likely to be himself. The 1929 crash did not happen to people. People happened to it. And that is the most important lesson of all. If this history lesson made you think differently about risk and leverage, hit subscribe. Every day on this channel, we study the principles that separate real investors from speculators. Tomorrow, we are diving into how Benjamin Graham turned the devastation of 1929 into the foundation of modern value investing. You will not want to miss it. Drop a comment below and tell me, what do you think is the biggest parallel between 1929 and today's market? I read every comment. I will see you tomorrow.